Sometimes we show people property and they go, well, jeepers, the stuff you buy is cheap, but it's not necessarily cheap in comparison to what else is around. Just because it's cheap compared to Auckland doesn't mean that it's actually cheap.
Wealth HQ, empowering you to take charge of your financial life.
Hadley Nightingale is back. He's the founder of New Zealand Property Buyers, an agency with buyers in mind. The company was founded on the basis that there's a severe lack of representation in the real estate market for the buyer. Every week, Hadley sees people who have limited experience of the process going up against career professionals who know how to get the best for their vendors. Hadley, are more people contacting you now with the OCR dropping twice?
I don't think more people have been contacting us more since the OCR drop. We've been pretty steady this year in terms of sort of client flow and what people are looking to do. I think there's been a bit of a spike in interest in people sort of chasing multi-dwelling properties. There's a couple of multi-offers that we're in now that we haven't been previously, but it's not all of a sudden LVR drops, demand spikes, because I still think there's probably still a bit of pressure on people from previously set interest rates and, you know, still that fear and perception out there that, you know, hey, is it going to drop again? Is it going to rise again? What's going to happen? So I think until we get some stability in the market with prices going down or prices coming back to level, then, you know, potentially we're going to see some more activity then. But it's the old case of that there'll be a huge rush towards the end of the cycle when people decide they're going to get drunk on property like they did in 2020, 2021. But it'll just take a bit of time to get some momentum before the FOMO really kicks in again and people get scared they're going to miss out.
And so from 2021, we've seen prices drop.
Yeah.
Like you said, it's been an interesting market last time we were on. How has the prices changed in the regions in the past 18 months?
Price in the regions are very hugely depending on sort of where we're buying. I think that the thing with us and the part with our clients is that we're quite heavily cash flow driven as opposed to equity. So there was that process and the run up to that sort of 2020, 2021 when things were going mad that we were highly cash flow driven to say to clients, look, if the market's getting a bit out of control, if we get ourselves to a position where we lose 10% off the purchase price of this, at least you're getting, you know, your property's cash flow positive. So you might have lost some equity, but you've got cash flow in there. And then what we're seeing now is that our drive on cash flow isn't quite as high because interest rates are higher, but there's also better opportunity now for equity to go and get that stored up before the market ramps up. And we're in this for like the long term. So if we drop for a little bit and then things come back again at a later stage, great, but we've locked in that long term sort of purchase rather than just trying to, you know, what does year one look like? Jeepers, it doesn't look good. Let's get out and flag it, because I think that's where a lot of people go wrong. Is they look in short time frames and expect they're going to make $1 million overnight the first property they purchase, but they forget how well they can do over sort of 10 years.
So talking about potential, when it comes to properties in the regions versus urban centres, how do you differentiate that potential? Do you sort of see it's a similar outcome that you can get in those two different investments?
Well, I think the biggest thing is we just need to work out strategically what we're trying to do. So if we're chasing cash flow, we've obviously got to go to the regions where the prices aren't as high and the rents are high. Whereas if we're chasing equity, then we're generally better to go to a bigger city. So, I mean, like, for example, if we put like 4% growth across $1 million property and said that we get 4% growth for the next for every year now after, not that always happens, but just for easy maths, yeah, we're making $40,000 a year on those properties. Mm-hmm. If we're looking at a $500,000 property, we're making $20,000 a year for the same growth. So depending on what our strategy and our outcome is, then that's where we've sort of got to go to the areas second, and then we look at property sort of last. So if the strategy is cash flow, then we need to go to the regions because that's where the yields are better. If we're looking for something that's more equity based or where there's going to be potentially more growth because there's more population, then we've got to come to the bigger centres. But I mean, when we look at New Zealand in comparison to the likes of Australia, I've had some people say to me, look, that are Australians that have come back to New Zealand that have said, oh, look, there's so much data in Aussie. like I can buy in Sydney and then like the Melbourne market's different. So surely that's got to be different to like Auckland, Christchurch, Wellington. But when you look at like from a population base, when we've got nearly 20% of the population that reside in Auckland, and then the next at sort of 1 million people, and then the next one's like Christchurch at 300,000, it's really hard to compare like data and markets when you're that far apart, as opposed to the markets in Australia for like Sydney, Melbourne, Brisbane. They're all big populations. Sydney's obviously the biggest, but they're relative. There's not like a third and then 2/3 from side to side. So when we're sort of comparing those markets, we've got to look at like population size, what's happening there, and then tailoring that.
In your investment philosophy, what is an acceptable region size?
We probably don't want to look for anything under sort of 25,000 people. Starts to get a little bit small, but then we also need to back that up too with what's the infrastructure there, what are the jobs doing. If we go back to like we're saying 2020, 2021, where everyone was rushing to the west coast of the South Island just because it was cheap, and you can get great yields there. But it's the old saying, cheap isn't always good and good isn't always cheap. If a mine shuts down, or if they've got a freezing works there, or all of a sudden the passes are shut off and you're isolated from the east coast of the South Island, then there's really nothing driving those sort of economies other than the rental market itself. And I think that's probably where you've got a problem. If the rental market's the main driver in the town, then you've got to start asking questions as like, well, what happens if people leave? What happens to the rental market then when it's not so much industry and jobs that are driving what we're doing there?
To me, 25,000 seems like quite a small number. Is there any relation to proximity in terms of 25,000 within what radius?
Yeah. So I think it also comes down to, like I say, the infrastructure and what's like happening there is the thing. Where's it close to? And I think when I go back to the west coast of the South Island example again, it's like, there's a population base there, but it's a long way from anywhere. Most of the North Island towns are relatively close to another sort of major centre. But then, it's sort of key to look at that. So, like, for example, the further north you go from Whangarei and the further west, those places are relatively close to Whangarei. But they've got populations of like 5,000 people or 5,500 people, and somewhere like Dartmoor, maybe 10 on a really, really good day if you expand it as far as you can. And there's a freezing works and there's a little bit of infrastructure there. But all it's going to take is for the freezing works to go into business. People can commute to Whangarei as well. But it's like, what else is there to support that local sort of region to drive those prices?
So I've quizzed you before the interview. You do somewhere like 40 to 50 transactions a year when it comes to finding properties for investors.
Yep.
What are you seeing as the most popular type of properties right now?
At the moment, in terms of the most competition we're coming up against is in the multi-unit space. I suppose people are sort of very focused on, people that are coming back into the market are very focused on that. They see the interest rates, they see the cash flow, and they're going, right, that's the multi-unit stuff's exactly what we need. Some of the best stuff we've done recently has been, around the single houses. Can we add a granny flat on the back of it? What else can we do to sort of generate more income, rather than maybe specifically going direct to standalone multi-unit house that we can renovate, cash flow's good, and move on from there. So it's really just a case of also becoming a bit more creative around what you're doing as well. Just because something doesn't necessarily look good on paper year one, how can you be creative around that to get yourself to where you want to be in 2 years' time or 3 years' time?
You talk about multi-units as a popular type of properties, but your last two purchases, they both were BRRRR strategy, right? You were able to buy something undervalued and you're doing renovation. Maybe tell us a little bit about that.
Yeah, the first one we bought in 2021, we bought in November 2021, top of the market, just as the CCCFMA legislation came in. So that one there, we probably paid too much for it at the time. But I think it comes back to the thing of, what our plan was to renovate it. That place now is Airbnb'd and it's pretty much fully booked between now and January. So we didn't go down the conventional renting route. It's been changed into Airbnb. We've also lifted the value by turning it into a 3-bedroom property to a 4-bedroom place with an ensuite, and a couple of little things like that. And then the latest place that we've just bought, it had been on the market for 6 months. Saw it, thought, we'll throw an offer in just with a finance clause and see what happens. And then, to our surprise, the vendor accepted it. And then, for that one there, new carpet, paint. The carpet's fine. So new paint, kitchen, bathroom, and then we're turning the downstairs of it into an Airbnb also. But that one there, the potential for that, and I think we probably don't talk about this enough, is like our stage, just because we buy something today, what does the stage 2 of that look like? So for that particular property there, what we're trying to do is freehold the title, because it's a cross lease at the moment. And then we can build another 2 townhouses on there because it's medium density zoned at the moment. So looking at things like your zoning and what that future potential is to go, well, look, if we bought really well, the neighbouring property just sold for $100,000 more than what ours has, and then we need to take a bit of a discount because it was freehold and not cross lease the neighbouring one. But we bought really well, and then what's the future potential of that to then go and increase that equity, and then look to sell those or sell the front house at a later stage.
So if you're buying a property that doesn't have positive cash flow or neutral cash flow, how much equity are you looking for? What would you say, like, the rule of thumb is?
I'd say you want to make at least $100,000 out of it, as sort of as a starting point. And I think it's probably where maybe people get a little bit blinded. They go so heavy on cash flow, or they find something that's got sort of limited equity, or if any equity at all, and then they go, right, it needs to be cash flow positive from day one, and they make, say $1,000 we'll be really generous and say that it makes $1,000 a month, which at the moment is sort of impossible to find, but let's just say for argument's sake it does. And they're making $12,000 a year, or they can go out and they can buy something where they can make 100 or 150 grand's worth of equity. We'll say 120 grand just for easy maths. That the equity that you can make, and that as soon as you buy it or after 3 months from the renovation, is like 12 years of cash flow. And then by the time you take inflation into account and things like that, you're probably looking at 15 to 20 years to try and make up just the difference in the equity side of things. And then also over that time too, your rents are going to increase, so your cash flow is going to get better on that number as well. So I think it comes down to the thing once again of like looking at your overall position. What's my accumulated profit over time, so that you can see that year 1, we're at negative, say $5,000, but then by the time we get to year 3, we're from a P&L perspective, we're back in line. And then by year 6, we've paid off all the money that we've spent from a profit perspective. And then on the next line down, from an accumulated perspective, we've made $100,000 worth of equity this year, or $120,000 worth of equity this year. And if we put growth out at 3% to be extremely conservative on things, then how does that stack up? And then what's our overall position for the year? So we could turn on a property because it's got negative $5,000 cash flow, but then when we look at the $120,000 equity minus the cash flow for the year, we've made $115,000. But we've turned our nose up at it because it's gone, it's $5,000 negative, so we don't want to touch it. So I suppose that the question to people then becomes, well, do you want to make $115,000 or lose $5,000?
Hadley, what's your outlook for regional property market over the next 5 years?
I think in terms of population growth, it's still there. As I say, it's really important just to be strategic about where you're buying, what new projects are coming to town, what are we, what's the infrastructure like? Are there any new roads that are linking other places up to up to the towns that you're looking to buy in? Is it going to be easier to get to and fro? The likes of Whangarei, where the government's just announced now that they're going to put, it's going to take them 15 or 20 years to build. I'm probably being a bit generous to them at 15 to 20 years to build the rest of it, but there's still that thing of like easy connectivity is coming. So with that, there's population growth there. It gets easier to get to. Businesses go and invest in there. So it's also about looking sort of longer term as well, and then moving yourself into those types of areas.
What are some upcoming infrastructure projects that you are seeing that's worth for people to consider?
I think the biggest one at the moment is, like I say, just the the outlining of that Northern Motorway up to Whangarei that's going to unlock a whole lot of stuff. The other thing too is the new fast track legislation that's just come out, where there's 150 odd projects that are labelled in that. I think there's probably some big opportunity there for Whangarei. They've got the port extension. They want to put the dry dock in there. So therefore there's jobs. And then also too, like I say, with the motorway for connectivity, definitely.
What advice would you give someone who's looking into the regions for the first time?
Regions for the first time. Just know your market. So making sure that you understand sort of what we've been talking about the whole time here. What drives it? Is it rental driven? Is there other infrastructure there? Check that it's not a one-horse town, and that if one business shuts down, everything's under the pump. It's a little bit like what's happened in the Ruapehu district at the moment with the 2 sawmills shutting down, which is the main employer. Extremely sad and not great for the people that live there. But once their main employer's gone, people move out of town. People that own houses there as rentals, what sort of happens to them? Can they repurpose them? So understanding the market, understanding what's comparable, because sometimes we show people property and they go, well, jeepers, the stuff you buy is cheap, but it's not necessarily cheap in comparison to what else is around. Just because it's cheap compared to Auckland doesn't mean that it's actually cheap in those areas. So knowing those comparables, knowing what a good street is, and I think that's the other thing for the regions too, is that like Auckland, we can talk about different suburbs and how they perform, and you go near this suburb and you wouldn't buy in that one. But when we're talking regional towns, it's like the street's good, the street's not so good, or even like half a street. Like the bottom end of street X isn't great, you wouldn't touch it, but the other end of the street's fine because it's just gentrified, and that's just sort of how it is. So just getting a really good area understanding. But first of all, before all that, is just understanding what is it that you're trying to achieve. Are you looking for cash flow? Are you looking for equity? What's that strategy to then go and look at the areas that are going to suit that, and then look at property last, as opposed to going and looking at a whole lot of houses, hoping that the area is going to be good, and then hoping that the strategy fits that. You'll narrow your search time down, a heap, if you can be really specific on the properties that are going to suit the other 2 metrics.
Really great insights today, Hadley. If you guys want to learn more about property and finance strategy, definitely hit the subscribe button. And if you found value in today's episode, please hit that like button.
Financial freedom. Financial freedom. Oh yeah. Financial freedom.
Wealth HQ, empowering you to take charge of your financial life.